stock market is plunging. And the question is, what will it take for prices to stop declining? This is a look at the historical evidence. Let me look first at the technical uh, picture. And the technical picture doesn't look good. This is the moving average behind the S&P 500. And when the moving average, as I said in previous videos, stops rising, this is bad news. That means that the market is likely to be weak or unattractive for several months. This is a technical indicator that anticipated this decline and also this decline here and is still going down. So the trend, the technical trend is down, no question about it. Let's look now at the fundamental data. And to me, the most important one is the trend of short-term interest rates. And what history shows that when short-term interest rates, this is treasury bills, by the way, the blue line, and this is the Wilshire 5000 going from 2004 to 2019. And what the history shows that a rise in short-term interest rates eventually is followed by a peak in the stock market. This is a rise in short-term interest rates, which has been followed by a peak in the stock market. The question is, what will it take for the market to start going up again? Well, history shows again that what you see at the bottom of the market decline, you always see short-term interest rates decline. No question about it. That's the condition for this stock market to stop its weakness. But there are other conditions as well. Let's see. Another fundamental force that happens at every major market top is the rise in credit risk. This is a chart going from 2017 to the last 12 months. And this is the credit risk as we measure it. And this is the Wilshire 5000 plunging. And what you see at every major top in the market is credit risk rises. Right now, credit risk is still rising. So the question is, what happens at market bottoms? At market bottoms, the credit risk has to go down. If the credit risk goes down and remains stable, then the market bottoms and goes up. But the market cannot rise with credit risk going up. The final important indicator is what happens in housing. This is the graph of home sales from 1996 to 2018. And what you see at every major market top, which is the red line, you see new home sales going down. In fact, they lead a peak in the market. This is again a peak in 2005, 2006. New home sales peaked, and then the market peaked in 2008. Here, the new home sales peaked in early in 2018, and did not do much since late 2017. And sure enough, is followed now by a market decline. The reason is simple. If housing, which is a big ticket item, is declining, means that there are financial conditions that are not prone to a strong economy and strong earnings. So the market resents that and declines. So what will it take? Will it take the market to bottom? Well, definitely it will take housing to strengthen, but especially the two parameters that we discussed before, which is lower short-term interest rates and lower credit risk. Those are the two conditions that the market is going to take off again. Right now, housing saying this is a real top. These are my 3 books that I wrote. This Profiting Bull Bear Market is a detailed analysis of what happens in the business cycle and how that impacts the stock market. This is used in extensively in the Peter Duck portfolio, which I added since 1977. And these are two books that are much simpler, easy to use, and is about simple, easy portfolios that perform very well using backtesting, extensive backtesting. So you might be interested in looking at those books as well.